Today, we're going to take a really hard look at the cornerstone of American retirement, the 401k. I mean, for decades, it's been pitched as the golden ticket to a secure future. But here's the question. Is this tool, which was born in a totally different economic world, actually built for the kind of volatility we see today? We're going to break down the common beliefs, challenge some of those core assumptions, and you know what? We're going to explore a completely different way of thinking about wealth. One that shifts the focus away from just hoping for growth someday to creating real income right now.
Okay, let's jump right in. Here's what we've got lined up. First, we'll talk about that wild emotional ride that is the 401k. Then, we're going to hit the single most important financial idea that most of us were never taught, the difference between net worth and cash flow. From there, we'll tackle the illusion of control in today's markets and then lay out a whole different blueprint for building wealth. We'll even weigh the ideas of one of its biggest champions, and we'll wrap it all up with a really big question about your own financial future.
All right, Section 1, the 401k roller coaster. This is all about the huge disconnect between that dream of a safe, predictable retirement that was sold to our parents' generation and the real anxiety so many people feel when they look at their statements today, especially with how crazy the economy can be.
You know, this quote really nails an older way of thinking, back from the age of pensions. See, for a long time, the deal was pretty simple. You work at a company for 30 years, and that company promised to take care of you in retirement. It was a defined benefit plan. The benefit was guaranteed. But then things changed. Pensions got replaced by defined contribution plans, like the 401k, and the name tells you everything. The only thing that's defined is how much you contribute. The benefit? That's a total mystery. All of the risk got shifted away from the company and put squarely on your shoulders. This chart, wow, it pretty much visualizes what we all feel in our gut, right? Your 401k isn't this smooth, steady climb. It's strapped to the back of a bucking bronco called the stock market. We've seen it time and time again. The dot-com crash, the 2008 meltdown, sudden plunges where people literally watch their life savings get sliced in half in a matter of weeks. That's not just a number on a spreadsheet. That's a deep psychological stress, knowing your future can get wiped out by headlines you have absolutely no control over.
In all that stress, all that anxiety, it leads to this right here. A feeling of being completely powerless. I mean, think about it. When your entire future is tied to the S&P 500, you're not the pilot, you're not even the co-pilot, you're just a passenger in the back. You put your money in, you pick from a tiny menu of funds, and then you just hope. You hope the market goes up. You hope you don't have to retire in a down year. It's a strategy that's based almost entirely on hope, not on a plan that you actually control.
And that feeling of just being a passenger brings us to what is, without a doubt, the absolute core of this entire explainer. Section 2, net worth versus cash flow. I'm serious. If you get this one distinction, it could completely change how you look at money and investing forever.
This slide just breaks it down so perfectly with this amazing analogy. Okay, imagine you own a house. One way to measure its value is net worth. You buy it, and you just hope the price of that empty house goes up over time. But until you sell it, it doesn't pay you a dime. In fact, it costs you money, right? Taxes, insurance, upkeep. Now, let's look at it through the lens of cash flow. You take that exact same house, but you put a tenant in it. And now, every single month, like clockwork, a rent check hits your bank account. That's real, spendable money. The 401k is all about the empty house. This other philosophy is all about putting a tenant in it.
So, there's a technical term for that empty house strategy, and it's called capital gain. It's the classic buy low, sell high game. The whole idea of a traditional 401k is to build up this giant pile of assets, a huge net worth, that one day, far off in the future, you're going to sell for a profit. Your entire success depends 100% on that future sale price.
And this is the house with a tenant strategy, cash flow. This is the ongoing, recurring income that an asset spits out. It could be the rent from that property, or dividends from certain stocks, royalties from something you created, or profits from a business you own. See, it's not a one-time event. It's a steady stream of income you can actually use to pay your bills and live your life, starting right now.
And this right here is the whole point. You can't take your net worth to the grocery store. You can't pay your mortgage with your portfolio's appreciation. You can have $1 million in your 401k and still be totally broke month to month, unless you start selling off the very thing you're trying to grow. It's the classic trap of being paper rich but cash poor. Real financial freedom isn't some big number. It's the moment your monthly cash flow from your assets is bigger than your monthly bills. That's the game.
This leads us right into Section 3, where we're going to go head-to-head with one of the biggest articles of faith in the 401k world. This idea that, don't worry, over the long run, the market always goes up. Well, does it? Just take a look at this timeline. It's a massive cautionary tale. Let's look at Japan's lost decades. Back in 1989, their stock market was on top of the world. Then it crashed. And it didn't just bounce back in a year or two. 10 years later, it was still down by more than half. 20 years later, still nowhere close to its old high. Get this, even after 30 years, an entire career for most people, the market still hadn't gotten back to where it was in 1989. This isn't some weird theory, it's history. It proves that markets can go flat for a very, very long time.
So let's make this real for a second. Imagine you were that hard-working, diligent saver in Tokyo in the late 80s. You did everything you were told to do. You put your money away for the long haul. 30 years go by, and your entire nest egg, your whole retirement dream based on capital gains, would be totally wiped out. This is the huge, huge flaw in a strategy that depends only on the market going up, and it's a risk we're often just told to ignore.
But wait, you might say, what about diversification? Doesn't that protect me? Well, yes and no. And this is the really important part. Spreading your money across 500 stocks in a mutual fund, that protects you if one company, say Enron, goes belly up. That's what's called non-systemic risk. But it does absolutely nothing to protect you if the entire system has a meltdown. Think about the 2008 housing crisis, a global pandemic, a sudden shock to the whole economy. When the entire tide goes out, it doesn't matter if you own 500 different boats. They're all going down together. That's systemic risk, and that's the big one that 401k investors are totally exposed to. Okay, so we have spent a lot of time taking apart the old model, so now let's shift gears. Let's actually build something. Section 4 is all about the cash flow blueprint, and this is less like a passive savings plan and way more like an active business plan for your money.
This here outlines a totally different, much more hands-on approach. It all starts with step 1. You actively go out and acquire an asset, not just a stock ticker, but a real thing, a rental property, a small business, a dividend-paying stock. Step 2, you put that asset to work to make money, real, spendable income. Step 3 is huge. You manage your risk actively. You don't just hope. You use contracts, use insurance, use analysis. And finally, step 4, you create what's called a wealth cycle or a wealth wheel. You take the cash flow from your assets to go out and buy more cash-flowing assets. It's a snowball effect that you build yourself.
And this right here is the holy grail of the cash flow strategy. The whole point isn't for the asset's price to just go up and up. The goal is to build a financial engine that produces a steady, predictable income stream month in and month out, no matter what the daily drama of the stock market is. Look, if your rental property is making you $500 a month after all your costs, that's what matters. Even if its estimated value on a website goes down for a little while, your income is separate from the market's crazy mood swings. Now, you can't really talk about this cash flow philosophy without mentioning its most famous proponent, Robert Kiyosaki, the author of Rich Dad, Poor Dad. So, to keep things balanced and fair, this section is going to take an impartial look at his core ideas, and also at some of the really significant criticisms that surround him and his work.
Okay, so on the one hand, you have his ideas, which were pretty revolutionary for a lot of people. He says your house isn't an asset, it's a liability because it takes money out of your pocket. He talks about using good debt to buy assets that make you money. But then, on the other hand, there are some serious cautions. His definition of an asset flies in the face of standard accounting. He himself admits to being over $1 billion in debt, which shows just how risky leverage can be. And sources have pointed to some really questionable advice on things like taxes and insider trading, not to mention a lot of questions about his actual net worth. The point here is just to lay out both sides so you can make up your own mind.
And all of this brings us to our final section. We've taken apart one model, and we've explored a totally different one. So now it's time to put it all together and ask which path you're really on. Are you hoping, or are you building?
This slide just lays it out so clearly. You've got two paths. On the left, there's the hoping plan. That's the 401k model. It's passive. You give up control to fund managers and the market, and your entire success depends on one single event in the future, the day you sell. On the right, you have the building plan. This is an active process. You stay in control, and your success is measured by something that's happening right now, the spendable income your assets are making today. It's really the difference between thinking like a saver and thinking like an entrepreneur.
And if you need just one more example of how much control is given up in the traditional system, check out this unbelievable number. 71% of people actually believe their 401k is free, that it costs them nothing in fees. And they are all wrong. The system is often designed to be confusing and out of sight,
and those hidden fees can just chew away at your returns for decades without you even knowing it.
So we're going to leave you with this one last question. After looking at all of this, the volatility, the feeling of no control, that critical difference between net worth and cash flow, it's really worth asking yourself, when you look at your own financial strategy, do you see a blueprint that you are actively building piece by piece, day by day? Or do you see a lottery ticket that you're just holding on to, hoping that one day it'll be a big winner? Because the choice between building and hoping, well, that might just be the most important financial decision you ever make.